Hi, I'm Roger Montgomery and welcome to this week's Video Insight. I believe the prospects for a good year in equities hinges on a backdrop that combines disinflation, declining rates of inflation, with positive economic growth. Now, there will be fears that inflation spikes and economic growth stalls or slides backward. And those fears alone will be enough to cause equity markets to stumble, as they have in recent days. However, as long as those fears aren't realised, any slide in equities represents an opportunity to add to equity holdings, especially small caps. Importantly, if inflation reasserts itself or a recession does transpire, the good times for equities may in fact end. So it's really important you keep that in mind. It's also worth spending a little time thinking about what central banks, particularly the US Fed Reserve, thinks about all of those issues. Their utterances about the path of interest rates surely provides an insight into their expectations for both growth and inflation. And it's fair to say that as April unfolds, the economic narrative that once seemed certain is arguably a little bit more complex or nuanced. Not long ago, economists and commentators were betting on a series of Fed Reserve interest rate cuts commencing in June. They envisioned an economy that would smoothly transition to a soft landing as well. The most recent developments have clouded this straightforward scenario. Less than a month ago, the CME FedWatch tool, which is a barometer based on futures prices, signalled a robust 74% likelihood of at least one rate cut by June. Fast forward to today, and this prediction has softened dramatically to a less certain 58%. What's interesting though is that expectations of a rate cut in July are now almost 100%. The shift, however, isn't without reason. A fusion of strong growth data and the Federal Reserve officials' hawkish sentiments has jolted markets into a reassessment, pushing the prospects of rate reductions to be both milder and more distant. These reassessments inevitably cause the markets to stumble. Setbacks are normal and arguably are somewhat predictable. In fact, back in November, in a blog post I wrote entitled "The RBA Acknowledges Boomers Win and Mortgagees Lose," I wrote, quote, "Contrary to expectations of declining interest rates, we might find ourselves looking back in a year's time and discovering that rates have remained stubbornly stable and high." This time around, markets appear particularly reactive to evolving expectations. The first few days of April have already seen a sell-off in longer-term bonds, propelling the yield on the US 10-year to 4.41% from 4.21%. Now, this movement was partly ignited by a robust report on manufacturing activity from the Institute for Supply Management. Meanwhile, several Fed Reserve officials have promulgated a cautious stance against premature rate cuts. For instance, the Atlanta Fed President, Raphael Bostic, now sees the possibility of only one cut towards the year's end. Cleveland's Fed President, Loretta Mester, and Fed Governor Christopher Waller have echoed similar sentiments, emphasising the economy's resilience and the potential inflationary risk associated with hasty monetary easing. At the heart of these discussions, Federal Reserve Chairman Jerome Powell, his recent sentiments provide a nuanced view. Speaking at the Stanford Graduate School of Business only a day or two ago, he emphasised a need for patience, reinforcing previous announcements the Fed would not consider lowering rates until there's a clear path towards achieving a sustainable 2% inflation rate. While the approach of making policy decisions meeting by meeting reflects a deliberate and data-driven strategy, it highlights the cloudy nature of the current state of affairs. The bottom line is, some say US growth is robust and others say not so. And ongoing inflation concerns in the United States are installing a few roadblocks in front of an otherwise optimistic outlook. But for now, we can earmark rather than fear descriptions of the market being exuberant or in a bubble. That does not seem to be the case. That's all we've got time for this week. Look forward to talking with you again next week, and in the meantime, continue to follow us on Facebook and X.